All right. Good evening, everyone. Thank you for joining tonight's webinar, Entrepreneurship Through Acquisition 101. I'm Joe Cortese, co-president of the Chicago Booth Alumni Club of Chicago and a principal and senior consultant with DeMayo Schneider & Associates. I'm really excited to host this webinar tonight with Brian O'Connor as our guest. Some of you may know Brian from his role as adjunct associate professor of entrepreneurship at Booth. Also, in addition to his teaching responsibilities, Brian is the founder and managing principal of NextGen Growth Partners. Brian founded his firm around the concept of ETA, so he's clearly well positioned to enlighten all of us on the topic. The format of this webinar will be a fireside chat. I have some prepared questions for Brian to get us started, and then we're happy to incorporate questions from the audience as well. If you would like to ask a question during the program, please simply use the Q&A function that you should see at the bottom of the Zoom feature, and we'll monitor questions and bring them in as we go. Lastly, I'll mention quickly, we plan to host a series of webinars based on ETA over the next few months. Subsequent conversations will dive deeper into the concepts we'll be covering tonight, so please be on the lookout for information on future events. So with that, let's dive in. Brian, nice to see you. Hope all is well, and you're, first of all, you're safe and healthy amid the craziness here. Really appreciate you joining tonight.
Yeah, thank you, Joe. Good to see you, and thanks everybody for dialing in. Healthy, safe, relatively sane. Everything's about as good as can be expected. Yeah.
Excellent. Great. You know, I'd like to start with your background, Brian, and your journey to founding a firm focused on ETA. You've lived the ETA model for the bulk of your professional career. So let's start by having you tell us kind of your background, how you got to that point, and kind of what has led you to where you are today.
Yeah, sure. Happy to do it. So yeah, I guess we'll have, my bio is a little bit of a backdrop there. But I began my career in corporate M&A and principal investing, private equity, not dissimilar to many future Booth students and Booth alumni. So really about the first decade of my career was with the Zell organization. So led by Sam Zell, his series of companies, many of them real estate, many of them are private equity investing vehicles. I really kind of cut my teeth in M&A and private equity investing within the Zell universe. In 2010, after having graduated from Booth in 2008, I became aware of this really cool model called a search fund. And it might be something that some of the folks that are dialed in tonight are familiar with. We're going to talk a little bit more about what search funds are all about and what broader entrepreneurship through acquisition is all about. But frankly, in 2010, I became aware of this model really just over a conversation that I had with a few of my friends that had graduated from Stanford GSB, which is really where a lot of this investing model kind of was born in the mid 80s, and we can talk a little bit about the history of the asset class. But frankly, we were just catching up, a few old friends, and the conversation kind of came to be around this whole notion that we were sort of growingly frustrated with our level of involvement that we had with the companies, these great small businesses that we were investing in, but the limited amount of influence and involvement that we had in the ultimate growth and sort of the plan associated with executing on the growth plan and equity value creation strategies in these businesses post investment. So the conversation quickly turned to sort of this model called a search fund, which unbeknownst to me at the time was a really great way to put together a little bit of capital with the ultimate end goal of searching for, finding, structuring, acquiring, and then most importantly, leading post-acquisition a business, typically a small or mid-sized business that you would then operate as the leader or the CEO of that business going forward. So I did just that, Joe. In 2010, I left sort of the comforts of private equity to go out and raise a little bit of capital. Ultimately, over a period of 9 months of searching with my then partner, ended up finding a great little IT services company. We can talk a little bit more about that business and what made it attractive and appealing to us back in 2010, 2011 timeframe. But we ended up structuring a really interesting acquisition of a control position in that business, ultimately led that business. I, as the co-CEO and head of business development for the period of about 3.5 years over the course of mid-2011 until early 15, and ultimately took that business through an exit process after being approached by 2 strategic buyers, unsolicited. The business was growing quite significantly and caught the interest of a few different folks that were would-be acquirers of the business. That got us all thinking about a potential exit, and we ended up engaging an investment bank and ultimately ended up selling to not one of those 2 buyers that sort of initiated the whole process, but to a private equity group based out of New York. So that was in early 2015. And ultimately, at that point in my career, Joe, I sort of said, well, gee, there's this really interesting model of investing in, tried and true and proven in private equity. And then there's this whole other universe of search funds and entrepreneurship through acquisition that has its really great merits to it that I think we're going to get into tonight. And when you marry the 2 of those, the best pages out of the private equity playbook and the best pages out of the search fund playbook, really special things can happen. And that's really the basis with which I founded NextGen Growth Partners in mid-2016. And we've been buying small businesses alongside really talented, relatively early career entrepreneur operators since.
That's fantastic. We have our first question from the audience from Drew. He asks about, in today's climate, do you see companies being acquired at lower multiples? Drew, we're going to get to that in a little bit. So let's hold that one for a couple minutes, and then we'll speak to, sort of the dynamics of the market that we're seeing. It's very interesting, Brian, and thank you for going through your background there. So when you started down this path, were you aware of, the tremendous opportunity set, or i.e., the ripe sort of picking grounds that are out there with the types of companies that we're talking about, and that could potentially be targets of an entrepreneurship through acquisition business model? And so I wanted to ask you that, and then if you could kind of go through what you're seeing in the marketplace and how these dynamics are playing out today, I think it'd be helpful to set the stage there.
Yeah. So, the short answer to your question, Joe, is no. I wasn't really aware of the enormity of this market of smaller firms that generate, you'll see on this slide, 5 to 50 million in annual revenue, or, we often think about it in terms of EBITDA. So, 1 to 5 or 1 to 6 or $7 million in annual EBITDA, which is usually a pretty good proxy for free cash flow in these types of businesses that are usually in favor in the ETA community. So the short answer is, back in 2010, Joe, this data that you see here is part of some research that we put together at Booth, and really it wasn't available. Just knew that I wanted to roll up my sleeves and operate a small business. And this model whereby I could take some of the skill sets and lessons learned through my career in private equity was a really interesting and available one to me at that point. And so this notion that there are greater than 200,000 businesses in the US that generate between $5 and $50 million in annual revenue, which make for really interesting targets in the entrepreneurship through acquisition world, and that approximately half of the owners of those businesses are approaching retirement age, creating a really interesting need for economic and operational succession. That was all sort of after the fact validation of my pursuit of this model. And frankly, it makes a very compelling case for those people that might be inclined to pursue this path, given the imbalance, frankly, that is very different than what you find in mid-market private equity, whereby there's a tremendous amount of capital chasing a finite universe of potential targets. Really quite the opposite is true in this part of the market, where you have very little organized and sophisticated capital chasing an enormous, what we like to think about as in a lot of the industry theses that we do at our firm, TAM, or total addressable market. I mean, the TAM here is enormous relative to the amount of sophisticated buyers and organized capital that is chasing after these opportunities.
Yeah, that's fantastic. Yeah, well, my firm, we're investment consultants, and we often talk about how, there's 6,000 publicly traded companies in the U.S. today, which obviously is a very small number compared to, the 112,000 companies you have listed on this slide in the private universe that's out there. So clearly garnering more and more interest from investors and business owners alike, and obviously that's a huge factor in all of this.
Well, I think I'm told we have about 200 people on the call, but if all 200 of us could just kind of keep this a little bit quiet, that'll be better for all of us. So let's enjoy the imbalance that exists and the opportunity that exists in this part of the market. But Joe, don't tell all of your institutional friends about this.
Your secret is safe with us, Brian. No doubt. Fantastic. Well, let's continue on here. Wanted to take a look at some of the historical data surrounding the ETA business model. What are some of the key factors that have made this a successful strategy in the past? How can we sort of, look at that data and sort of extrapolate it out? What are we looking for in terms of multiples and those sorts of things?
Yeah, so unlike, data that's very available in public equity markets and even in, mid-market private equity, the data there's not a robust set of data. So what we're going to do here on this slide is take a look at this research that Stanford regularly puts out on the search fund model, which again, we'll get into the nuances of what that actually means, what a search fund means. But let's for a moment take that data as a proxy for the broader themes and trends that exist in this universe of entrepreneurship through acquisition, whereby a really talented Booth alum would go out and raise capital, whether it's through a search fund or an affiliation with a private equity fund like the one I manage, or through their own savings and their own personal and professional networks, right? Let's take this data for a moment as a proxy for those different paths that we'll talk a little bit more about. So, as you can see, according to the research, the asset class has generated some very interesting returns since the mid-'80s when this business model was founded in Palo Alto in collaboration with a gentleman by the name of Irv Grousbeck. That might be a name that people are familiar with. In collaboration with one of his students, again, in the mid-'80s, they decided to put a little capital together, go out and buy a business that student would ultimately go and take the leadership position in immediately post-acquisition and drive growth and value creation within that business. So very interesting asset class returns. Even when you exclude a handful of outlier outcomes, you really still arrive at close to a 30% internal rate of return. One of those three outcomes might be a household name for many people on this call. The company Assurion was a business that was originally a different named business, and the model has evolved over time into the largest provider of cell phone and mobile device insurance. So many of you, if you have insurance on your mobile devices, it's very likely provided by Assurion, which is a massive company now. So a few things that they cite and we also would reiterate here. And we'll use the analogy of sort of like a horse, a jockey, and a trainer. So the horse, and we're typically talking about small recurring revenue businesses with relatively simple operations. But these businesses do have enough cash flow at time of acquisition and enough health and profitability and growth to sustain temporary headwinds. And very relevant sort of point here, given all that's going on around us. But so you'll find that the median EBITDA of these businesses at time of acquisition is right around $2 million. Different models will have different EBITDA entry points. So typically in a self-funded, again, this model we'll talk a little bit about, you might find slightly smaller acquisitions, maybe $1 million in annual EBITDA. And then, search funds tend to hover around, $1.5 to $2.5, $3 million in annual EBITDA at time of acquisition. And then you can get into some larger acquisitions. Typically that will happen if you're, again, affiliated with a family office or a funded private equity group like NGP, the firm I'm in. Again, these are typically businesses with existing profitability and growth, healthy EBITDA margins at time of acquisition, and a pretty attractive incoming growth rate of right around median 12% at time of purchase. So these are not languishing businesses in tired and deteriorating industries. These are very much good, fundamentally sound businesses in healthy, growing industries and end markets. They just happen to be undersized relative to their mid-market counterparts that have become the darlings and very competitive assets of mid-market and upper middle market private equity. Typically low entry multiples. So, I was actually a little bit shocked by this data. They report a 6.3 times trailing 12 months EBITDA multiple at time of acquisition. I often see pricing pretty significantly below that. It's not uncommon to find good businesses in this universe that can trade in environments even prior to the COVID pandemic that we're living in right now, trading at 4.5, 5 times trailing 12 months EBITDA. And all of us are booth folks on this call, so you can understand and appreciate that even if you weren't to use leverage in the capital structure and you take EBITDA as a proxy for free cash flow, buying at 5 times represents an unlevered 20% free cash flow yield, which is pretty darn interesting, even if you just take the acquisition at sort of face value without any assumed growth going forward. Strategic prudent use of leverage. So, it's very likely that sub 3 times of those trailing 12 months of that 6.3 times trailing 12 months EBITDA, sub 2.5 or 3 times is usually from third-party debt. The rest coming from seller equity rollover, seller financing, and the equity from you and your ultimate investment and sponsor group. So the jockey, worth spending a minute on the jockey, because that's what all of us are really in this analogy. Typically, the folks that are pursuing these acquisitions with the intention of leading them on a full-time basis post-acquisition are relatively early career, coachable business athletes, usually post-MBA and usually post-top-tier MBA, which is good news for everyone on the call. Again, I think the business athlete piece is important when you think about these businesses that are recurring revenue with simple operations. So typically you're not going to see a relatively early career business athlete buying a business that's overly technical or maybe plays in life sciences, or a business that requires a PhD level understanding of the subject matter to be effective in the CEO seat. Usually these are fairly simple, straightforward, B2B, mission critical, asset light recurring revenue models. And there's a lot of reasons why that is, we can kind of get into. But those are the situations that typically these early career business athletes find the most success in driving growth in these businesses post-acquisition. And then finally, the trainer. These are your investors. These are your mentors. These are your advisors with relevant operating and industry expertise that are going to help you out. None of us have all the answers in every business situation and in every industry, especially one that may be relatively new to you if you've made an acquisition in an industry that, say, you don't have a ton of operating experience in. So you're really going to want to, again, in this analogy, you're going to want to surround the horse and the jockey with those trainers that are going to be able to help them win the race at the end of the day.
That's great. Super helpful. We're getting a few questions here. So why don't we take a moment, go through some of these questions. Jose asks, how big a factor is timing of entry? Interesting question. Is it a good time to muster investor support in the back of the current crisis? What do you think about timing and clearly in the environment we're in? Do you think this is a good environment for these types of investments on a go-forward basis?
Yeah, I mean, it's a great question. We often, at least at my firm, we don't talk about timing the market necessarily. We talk about trying to find good businesses at good values. And when you have an event like we're living through right now, I think what happens in the immediate term is buyers and sellers go into a little bit of freak out mode. And that tends to widen, not contract, bid-ask spreads between buyers and sellers. That and banks that lend to these types of acquisitions, you know, many of them are still lending, but it's a different environment and people are being cautious and patient. So I think that what we'll end up seeing, you know, through the second and third quarter, perhaps into the fourth, is there will be decreased transaction volume. Now, things will still get done. Lenders in this lower middle market will still lend to good credits, and many of these businesses are very good credits at time of acquisition. But I think you will see a little bit of a slowdown in just transaction volume over the next couple of quarters. Now, that said, I think that as we emerge from what's going on right now, you may find that the business owner that owned a very healthy, profitable B2B recurring revenue business that generated $3, $4, $5 million of annual EBITDA, you know, that was maybe holding out for a premium valuation that they understood was commonplace in the mid-market. You know, you often talk about double-digit multiples, you know, or a business owner may have a conversation with a friend that has a bigger business or just a different profile of business, and they sold their business for 12 times. And in a market like we were living in 2019, you know, that might have been a flag that was planted in the ground for them. What I think will happen, and what tends to happen coming out of recessionary periods a la 2008, 2009, is that there is a little bit of a recalibration of valuation expectations on the seller side, whereby really good assets that can weather a storm like we're living in right now may become within reach. Those business owners may sort of dread the idea of living through another crisis like we're in right now, therefore accelerating their succession planning or their desire to enter into their next phase of retirement or whatever that looks like. And typically these situations are founder, owner, operator-led businesses, and the plan is to transition those to the buyer. And when you come with both an economic and operational succession plan, that becomes attractive. So I'll try to sort of veer back to the question. I realize I'm on a little bit of a tangent right now. I think it's all sort of related. But I do think in the medium to long term, coming out of a situation like this, there will be very interesting buying opportunities for those businesses that, you know, were on the edging toward $5 million in EBITDA and started to believe that they should command some of that frothy pricing that we saw in mid-market private equity.
I think that makes great sense. I agree with that. A couple questions about like specific sectors or specific areas where you see are there particular sectors or particular areas within the market where you see a majority of these transactions taking place? Or is your firm sort of industry agnostic? A couple people mentioned retail, consumer, tech. How do you kind of think about sectors, and do you see more representation than others? Yeah,
well, I'll speak for myself and my firm. Retail, no. Consumer, no. Tech, yeah, probably. And I'll tell you why I give that cavalier reaction. What we found has worked best in ETA broadly, and then also specifically at my firm, is that when you can buy an asset-light, recurring revenue, B2B service model that generates recurring and highly predictable streams of revenue from their client base with low levels of churn, that's a very attractive model to step into in any event, but especially when you're partnering with people that are extremely motivated, highly talented, but might be not this seasoned operator that has been around the track a few times in that as an operator in that particular industry. Those make for really, really good business models. And that's what we look for as a firm. So, we try to stay away from anything that's too asset or capital intensive. That capital then tends to be an inhibitor to scalability. We tend to look for spaces that are, have some tailwinds behind them instead of headwinds. So, when people start to talk about retail, I get a little bit concerned about some of the trends there. I get concerned around, cyclical trends. I get concerned around trends that exist around purchasing behaviors and things of that nature in B2C environments that don't exist as much in B2B environments. And you can tend to have business models that generate more in the way of recurring or at least repeat and highly predictable revenue streams from a base of highly loyal and extremely, again, predictable and reliable customers year in and year out.
Got it. Great. Let's move forward. You've mentioned this a couple times, the different sort of models that you've identified here. So why don't we go ahead and define those and talk about each of these a little bit?
Yeah, this slide is like embarrassingly simplistic in the way that it tries to distill down the universe of ETA into sort of like these three different categories or buckets. But let's see how this goes. Let's hit on them real quick. So, on the far left, you've got a self-funded approach. And what this means is you have someone that's dialed into this call that is compelled to go out and buy a business that they then intend to operate post-acquisition. They decide that for whatever reason, they maybe have some budget flexibility. They've built up a nest egg. They've got an ability to maybe take no or a reduced income for a period of time while they go about this endeavor, which is a full-time endeavor of really trying to chase down opportunities, usually directly with business owners. Usually you're developing an industry thesis, and that's where this all starts. And then you're building a pipeline of deal flow and conversations directly with business owners that you have good reason to believe have attractive businesses that may generate $5 to $50 million in annual revenue, just to use that same range. And you're developing relationships and communication with them directly, as opposed to going and pursuing things that are brought to you by an investment bank or a business broker. Those opportunities tend to be more competitive. Good investment bankers often, I've found, earn their fee. That's why it's always a good idea to hire one on the exit of your business. But as a buyer, it's tricky because often you'll have to find yourself into a position where you're going to be the highest bidder for an asset in a very well-run sale auction process, and we all know about the concept of winner's curse, right? So again, here I am on a tangent, but self-funded, you're doing this out of your own pocket, right? So you've built up a little bit of savings. Perhaps you have some family capital or a wealthy uncle. I never had one of those, unfortunately. But you've basically gotten into a position where you've said, okay, listen, for the next X amount of months or the next 2 years, which I often advise people is a good runway to think about fully developing a series of theses and chasing down proprietary deal flow, you are funding all of your salary and your pursuit costs out of your own pocket. Now, on the flip side, you've got full autonomy and control of your own destiny. Once you get into the search fund column or a sponsored search column, you have investors that now have an opinion about how their capital is used and how their capital is deployed and how you're doing that on their behalf, okay? Those models also on this third bullet in self-funded, the other two models, search fund and sponsored search, tend to have a pretty formulaic approach toward the deal economics associated with your acquisition. And I'll get to that in 1 second when I describe the search fund. Joe, actually, before I ask you to keep me honest on this column, I will add one last thing. Self-funded in this column here does not necessarily mean that the ultimate acquisition is fully self-funded. It may mean that.
Looks like we're
It may mean that the equity requirement associated with that acquisition is sufficiently small such that, Joe, are you with me?
It appears that Joe's internet connection may have frozen.
Okay, but Tim, can you hear me?
Yes, I can hear you just fine.
All right, all right. Why don't we, what do you advise, Tim? Should we carry on and hope that Joe can get back?
Joe, yep, Joe is logging back in. Hang on just a sec. All right. Joe, I think you're back.
I'm back. Can you hear me?
Yes, we can hear you. Terrific.
Of course, right in the middle of a webinar, Zoom decides to freak out on me. Apologize for that. Brian, you were talking about, you were going to get to the sponsored search column. You were still in the search fund column. Apologies for that.
Yeah, no worries, Joe. Do you want to cut back over to the presentation, or should we keep it like this for now?
Let me cut back over. I apologize. Let me share that here.
That's okay.
Thanks everyone for bearing with us. I think we're back up and running here.
I think we're all adjusting to our unfortunate new normal
life on Zoom
for the time being. I do wish we could all be in person doing this, but I was just making one final point on the self-funded. To be clear about this means that you're self-funding the search component of trying to find a business. You may find a very attractive business in the pursuit doing this self-funded, a business that generates, $7 million in annual EBITDA, and you structure a very attractive acquisition for that business at 5 times trailing 12 months EBITDA, and you may have to raise some equity financing to ultimately get that deal done. And you see self-funded searchers doing that all the time. The notion of self-funded just means that you're coming out of pocket for your own pursuit and advancing and diligence costs on would-be companies that you'd like to acquire. Okay, let's transition real quick into a search fund, because this one has a little bit of nuance that's worth explaining to those folks on the call that might not be as familiar. So in a search fund model, and this is the path that Stanford reports the most data on. This is the path that they've been collecting data for decades on and share their findings. And if anybody is inclined, they put out every other year, they put out their findings in a report that you can find on their entrepreneurship website. So here you have during your search period, you have a captive audience of investors and advisors. Because those folks have actually taken out their checkbooks and wrote you a check to go pursue an acquisition that you will go lead on their behalf. And just to put it into perspective, typically, I'm going to use very round numbers and broad brush strokes because we don't have all night to talk about this stuff. I wish we did. But typically, you would, let's call it, raise $500,000. And that might be from 10 different investors. So each of them are writing you a $50,000 check and saying, Joe, you seem like a very talented young man that's extremely capable of going out and finding a great acquisition target at a really good value and structure. And then my biggest bet, and I'll make that bet in a minute here, is that you're ultimately going to be able to roll up your sleeves and lead the people, make the changes, really drive growth and profitability in that business over the next 5, 7, 10 years, okay? That's a second bet that they're making. We're going to talk about that in a second. So in exchange for that $50,000 investment that they've just made in Joe, they get the right, but not the obligation, to participate in their pro rata share of the equity required at time of acquisition. So let's just say Joe finds a $2 million EBITDA business, and it's a really attractive B2B recurring revenue service business in a growing end market, and all the investors love it and they want to participate. What happens then is that $2 million EBITDA business, bought it 5 times, so $10 million in enterprise value. Chances are you're going to maybe lever that up 50% of the capital structure. So let's just say at that point in time, Joe needs to go back to investors with the notion of them funding a $5 million equity component associated with his acquisition. Those folks are going to have the right, but not the obligation, to participate in their ratable share of that equity component, which for each of them, simple math, would represent $500,000 opportunity to back Joe in his effort of acquiring this business and leading it through its next phase of growth. They can pass, and if they should so pass, or if they don't pass, there's an there's a risk premium that's applied to the initial investment that they've made in Joe for making a bet on him and his effort of ultimately finding and acquiring a business. There's some nuance to that you can read all about in some of the Stanford research. I won't bore you with that tonight, but there's a predetermined economic structure associated with that. Typically, that $5 million in equity that goes into the deal would be treated as a participating preferred equity security that would earn some sort of PIK, payment in kind, interest rate on it that would accumulate over the holding period of the asset. And then and only then, once Joe and his board of directors and his investors are ready to exit that business, and they satisfy all third-party debt obligations and all of the equity capital plus its accrued participating rate of return is returned back to Joe's investors, does Joe then begin to earn into the common equity value that's been created in that business above the participating preferred? I realize that some of this is pretty nuanced and pretty technical. We're covering it at a very high level, and there's plenty of research out there that you can follow up and dig more into. But Joe, again, in exchange for sourcing, structuring, acquiring, and busting his tail over the course of several years and growing this business, would then have a really exciting opportunity ahead of him. He would have the opportunity to lead that business as CEO, earn a salary and bonus and cash compensation package that would be commensurate with a CEO of a similarly sized business in that particular industry, which would be a fairly attractive compensation package. But then really the true economic opportunity comes on the exit, where Joe in the search fund model has a fairly prescribed economic package whereby he has the chance to earn into 25% of the common equity value that is created at that business. And that would vest in 3 different ways. A third of that 25% would vest at time of acquisition immediately when you get the deal done. The second third would vest over a 4-year operating period if Joe is in the CEO seat doing what he said he was going to do and executing on the plan. And then the final third would be performance-based. And typically there's a formula whereby there's a sliding scale of internal rates of return back to the investors. And if you hit sort of the highest tranche or the highest hurdle within that IRR scale, Joe then earns into his final tranche of his 25% of the common equity value. I'll talk about sponsored search in a much quicker way. Sponsored search is really a way, again, like I talked about, where you merge some of the best pages out of a private equity fund playbook, tools, systems, resources, infrastructure, committed capital that is available and ready to use at time of acquisition, support and involvement from investment professionals and advisors, sort of all that great infrastructure that private equity funds enjoy, plus you as an entrepreneur will affiliate with that group, earn a salary and diligence and pursuit costs all along the way as you search for the business, and ultimately earn into a similar economic structure as you would if you had decided to pursue the search fund route. So that feels high level enough, but enough to give people information to be dangerous in these 3 different paths.
I feel like I'm ready to go out and do it, that's for sure. A couple more questions here that have come in, I think are interesting. Mark asked a question. I think one of these, he has a couple questions, but I think part of one we haven't covered yet that I think is interesting. Says, should the seller leave, or what is the role of the seller in these businesses in the acquisition?
Yeah, that's such a good question. And the answer is it depends. You know, I mentioned earlier, often this is a great retirement plan for these business owners that maybe founded the business 30 years ago. He or she has been pouring their heart and soul into this business for the last 30 years. They've grown it to a point where they've just sort of said, like, this is great. It's a good business. It's generating a lot of free cash flow. That's been nice, and it's supported my lifestyle. But listen, I need to economically and operationally take a step back. And that's fine. And that happens all the time. You find situations, and we make investments at our firm that fit that category, and then fit the category of, you know, someone realizes and at an earlier point in their career that they need some outside involvement. They need Joe, who graduated from Booth in 2010, to come along and lead the team and build a sales and business development function and implement new systems and software and technology and bring this business into, you know, current day operating standards, right? Which many of the folks on this call are very familiar with in their various careers and what they're doing, right? It needs to be boothed a little bit. So in those situations, you know, you find that maybe that owner, operator, current CEO is interested in taking a role that looks more like head of product. You know, you have people that are really product or service oriented, right? And they built a business around being creative about product or the delivery of service, or a founder operator that's like really passionate about their relationships that they have with their customers. And so they want to, you know, focus their efforts on client satisfaction and business development. You kind of find a really cool role for them there. So you can have situations where there are sort of a new entrant, a la, you know, a Booth alum. They can add their own unique and really special skills and leverage those skills and capabilities and expertise that is inherent in that owner, operator, founder. You can really, there are numerous ways to skin the cat.
Got it. Another interesting question: how are skills gaps effectively addressed? I.e., you know, someone that is obviously has a skill in a certain area but needs other skills, you know, to be able to run the business and be the jockey in your analogy.
Yeah, this one hits home for me because I have so many skill deficiencies. It's hard to count them. I mean, listen, I hired for them. I surrounded myself with investors, mentors, advisors, a really well-appointed board of directors that frankly, like, had no business being the board of directors for a small, lower middle market company. It was really an outsized board, which served, you know, me extremely well. And, you know, these are the things that we're doing at our firm, right? With our entrepreneurs in residence that we partner with to go out and lead these businesses after we all acquire them. You know, we're surrounding them with hiring at, you know, the number 2 and number 3 levels within the organization, whether that's the chief technology officer, chief operating officer, a chief of staff, maybe a head of BD or a head of corporate development, maybe a head of M&A if roll-up is part of the strategy. So you're hiring for it, you're solving for it by the model that you should so choose, whether it's a self-funded, search-funded, or sponsored. Remember back to our analogy, you know, the trainers are very important in this, where you get your capital from and who you surround yourself with. You know, those are, and you do see people occasionally follow, you know, mainly the search fund path, potentially with a partnership. You know, if there's a partnership that really makes sense and 1 + 1 equals more than 2, one of the folks is really business development inclined, and the other one is really kind of back of house, finance, accounting, ops, human resource focused. Like, that can be a really nice 1-2 punch. You can see it solved for in a number of different ways.
Oh, that's great. Very helpful. Good segue as well. Let's take a look and talk about your firm specifically, NextGen Growth Partners. Describe NGP's approach to ETA. Highlight some of the investments your team has made thus far. Give us a little background on what you do day in and day out with the firm.
For sure. So this is a nice little, you know, I guess a snapshot of Fund 1, existing portfolio companies in Fund 1. So you know, finding the right business means different things for everyone, right? I latch onto, when I have conversations like this, again, I sound like a broken record, but this notion of like unbreakable, mission critical, you know, in this market of you know, essential services types businesses that are recurring revenue in nature and asset light and very scalable and represent a critical service for their clients that they serve to be in existence, okay? So like, and I would go a step further and say, and don't represent an enormous share of wallet. So when they look at their P&L during times like this and they say, boy, we need to defer payments to our landlord, or we need to furlough employees. Unfortunately, that's a reality that we're living in right now. Or we need to look at expense item, you know, line item X, Y, or Z. You know, you don't often look to these businesses, and I'll explain a little bit why, to kind of tighten the belt when they represent a mission critical but very appropriately outsourced component to a client delivering their good or service. Okay, MHW, I'll use this as an example. We don't have to get into each of these. I want to be mindful of time here. MHW is a really great example. So what this business does is, at a high level, you know, they do beverage alcohol compliance. So they're the mission critical service provider to both domestic and global producers of beverage alcohol. Any product that has beverage alcohol in it, as we all know, is highly regulated and is subject to the three-tiered alcohol distribution system. It's highly bureaucratic, highly complex, highly regulated here in the US. Just imagine how complex that is for a Mexican mezcal producer, or a Japanese sake producer, or a French Bordeaux producer. Those folks need a partner that is boots on the ground and has a system with which they help their clients on a contractual recurring basis navigate the complexities associated with getting their products into the US and through the highly complex three-tiered alcohol distribution system through their importation, compliance, and regulatory functions that they do on behalf of their clients that don't make sense to have that function as something that they in-house. Once a producer gets to a certain size, you know, I'll use an example of Jose Cuervo tequila, staying on the tequila topic. They may make the decision that that's a function that should be insourced within their organization. But the vast majority of producers, and many of the household names that we know, it does make more operational and economic sense for them to have an outsourced solution for this. So again, we don't need to go through all of the logos here, Joe, but suffice it to say, you know, we make a habit at our firm of partnering with entrepreneurs in residence, you know, that represent these business athletes that want to go roll up their sleeves and operate companies. We developed thesis, right? We developed a thesis in beverage alcohol compliance. We developed a thesis in freight post-audit. We called on anyone and everyone that would take our calls in that industry to try to develop relationships and conversations directly with business owners that we stood to believe generated between $2 and $7 million in annual EBITDA. That's typically the zone that we sort of look for. And we tried to find, you know, a needle in a haystack, frankly. And these are some of the logos where we did, you know, Record Connect, very relevant in today's environment. They provide the mission critical, HIPAA compliant patient record management, retrieval, and dissemination and release of information in hospitals and large healthcare networks. So again, a very mission critical component of hospital and healthcare organization operations, but it doesn't make sense for the hospital to have that as an in-house function when they're more focused on patient care and delivery of service and all the things that are core to operating a world-class hospital.
And a question along these lines, and maybe you could speak to how your firm does this. What are some of the best resources to find businesses to acquire, or how do you develop this target list?
Yeah, I mean, you know, there are some, you know, online databases. There are, you know, some technologies that you can use, and then there's like stuff that's as scrappy as getting the trade show list and combing it for all the exhibitors, figuring out which of those 1,000 exhibitors that are at the annual release of information conference and trying to call on them and take meetings with them and attending the trade show and trying to get their business card and following up. And so, there's a lot of different ways. You got to get really scrappy and really resourceful. And then listen, I don't want to dismiss entirely the notion that you can establish lines of communication and relationships with business brokers that may specialize in a certain space. I just caution people against, kind of combing through every business brokerage or investment banking publication that comes out, because that stuff tends to be pretty picked over. The best banks and brokers will run very competitive processes. And, in the market that we were living in leading up to, this COVID pandemic, that was a pretty well-traveled path. I mean, even though this is a part of the market where there's not a ton of organized and sophisticated capital, there still are people chasing down those opportunities. Sometimes it's a larger strategic buyer. It's a company that has an acquisitive mandate to buy up smaller competitors on an accretive basis, and you could run into competition there. So, I guess I just go back to you got to be resourceful. You got to be scrappy sometimes. You got to look under a lot of rocks and find some resources that have lists, or you can become part of trade organizations, et cetera, and knock on a lot of doors.
Yeah, I guess if they were easier to find, the returns wouldn't be so attractive, right?
Yeah, I think that's part of the dynamic. Yeah.
Speaking of that, let's take a look at some potential outcomes for, as you call them, the entrepreneurs and residents. What could this potential path mean for somebody that's interested in this and that executes on this type of a model?
Wow, I don't know if I've seen this slide. Our team has the ability to make that much money. That's great for them. So here's the scoop on the EIR deal, and it's effectively the same as sort of the search fund deal, right? So let's take a look at these assumptions here. So you assume a $4 million EBITDA entry at time of acquisition, which just so happens to be across all of the investments that we've made our average entry point. 4.5 times purchase multiple, which is pretty much in line. 50% of the capital structure and debt, which again is about right. You pay down some debt along the way. So yeah, here's what happens. The business, again, at that purchase multiple generates a really nice free cash flow yield. But then once you start growing it, some pretty interesting things happen, right? So assuming a 5% EBITDA CAGR, I think is likely the assumption there. The entrepreneur in residence at time of exit, assuming a 5-year hold, stands to earn, $3 million in the compensation that, in addition to the compensation that they've earned along the way as CEO of that business, right? You grow it at 10% under these same assumptions, and it's, $6.5 million at time of acquisition. 15, it starts to get, even more interesting at 12 million, sort of their take of the sale proceeds, and at 20% CAGR, close to 18 million. And if you get one that really runs on you, the numbers can get pretty big, right? So, and this is a customary, look at how this, EIR path with our firm specifically, but more broadly, the economic, the available economic outcome, I guess, in the ETA space broadly.
Great. Speaking of that, let's take a look at some of the folks that you're working with thus far. Just so we've got about 5 minutes here, just so folks get a sense of who these folks are that you've worked with thus far. Again, if any last-minute questions are out there, go ahead and enter them into the question and answer box. We'll take those as well in the last.
Yeah, well, let's keep this quick. This slide is just the folks that are currently searching today, that are looking for businesses to acquire in partnership with our firm. This is not pictured here are any of the entrepreneurs in residence that have become CEOs of our portfolio company, right? So these are folks that are currently partnered. So Jake, Nick, Kyle, and Dan, 2 Booth alums, a Kelly School of Business out of IU alum, a Kellogg alum. Don't hold it against him. But these again are folks that are out partnered with our firm. They're fully funded. They're out pounding the pavement, trying to find really great businesses, again, that generate $2 to $7 million at time of $2 to $7 million in EBITDA at time of acquisition. And they've got varied work experience. Some of them come from, more, I guess, what I would call, I guess, like traditional sort of MBA paths, like a banking, private equity, or consulting background. Some of them are entrepreneurs. Some of them are operators. You'll find all sorts of different profiles and different backgrounds deciding to pursue this path. I think there's a common thread, though, in, these are really, really talented and motivated and driven folks. I call them the 4-H club. It's a little bit cheesy, but the 4 H's are for heart, hunger, hustle, and humility. And frankly, if you've got those, coupled with a Booth MBA, like, you're in pretty good shape. You can pretty much figure a lot of stuff out in this part of the market as a small business operator. Again, if you do all the right things and you organize the right infrastructure around you and the right advisors and the right mentors and the right, again, you need to land on, back to the analogy, you need to make sure you're riding the right horse. You are the jockey in this analogy, and you need to absolutely surround yourself with the right trainers. But if you get that right, there's big opportunity.
And are you specifically looking for every candidate to have a postgraduate degree, an MBA?
Yeah, at our firm we do favor post MBA, and specifically post MBA from a top tier program. So we spend a lot of time getting to know Booth alum, Kellogg, Stanford, Harvard, Wharton, spent some time at Kelly School and Ross. They're right in our backyard, kind of thing. But yeah, we do tend to favor post MBA.
Got it. Great. Well, we've got just a couple minutes here. I really want to take a moment, Brian, to thank you for your time. I know we've got some information from your firm here on the last slide. Thank you so much for joining. This has been a really enjoyable meeting to host. I'm looking forward to doing, again, a few more of these with you over the coming months as we can dive deeper into some of the concepts here. I would encourage anyone that was joining us tonight to reach out if you have questions. Certainly happy to follow up as we go from there. But again, Brian, I want to thank you for your time. I also want to thank everyone that joined the meeting tonight. Really appreciate everyone's participation. Want to say again, in light of everything that's going on, hope everyone is safe, hope everyone is healthy, and look forward to more of these in the future. Thanks so much, Brian. Have a wonderful evening.
Yeah, thank you, Joe. I really enjoyed it. We'd love to hear from anyone who's interested in what we're up to. Yeah.
Excellent. Take care, everyone.